Yeah, I mean, the big question is if we chase this rally, do we add new capital to work today? And we think that the answer to that is no. Now, we do think that we could continue to see the rally in the very near term. We see things like momentum and breadth be a lot better this time around compared to the other rallies we've had year to date. We've also seen better performance out of cyclical risk-on sectors. For example, small caps have been outperforming really since May. But then the question is, where do you go from here? And that's where we think that there's a challenge with valuation. We're already trading at nearly 19 times earnings. That's where we peaked in valuation back in early 2018, early 2020. So we think valuation effectively puts a ceiling on this rally.
I guess if you say perhaps it's going to get tougher from here to add on further upside, do you think that the market has shown you enough to say that June was likely the low?
Well, I think that those momentum and breadth indicators really do create the probability or lessen the probability that we make a new low or retest those lows. Because we've seen good breadth in this rally, that means that a lot of names are participating in the rally. When you see breadth statistics like that, it is supportive that we could advance from here, or that at least we won't retest.
It reminds me in that respect of coming off of the December 2018 bottom, where, of course, you had for a moment it was down 20%. It was a more brief sell-off, but there was the so-called breadth thrust off the low. And by the way, the market also did not have much in the way of valuation support going for it at that time either. So I just wonder if we can say that not so much that it's an all clear, but that it's now time to assume that the low is in and dip should be bought?
Well, the big difference between today and 18 or the lows we saw in 20 or even 16 is that we had real Fed pivots those times, and not Fed pivots that it was, oh, we're going to tighten less or slower. It was Fed pivots where you actually saw liquidity start to get more abundant in the market. So you saw measures like money supply growth start to reaccelerate. And what that did is that supported valuations moving higher. But the Fed has been very vocal, even with this rally since the July meeting, that they're not inclined to cut rates early in 2023. So we struggle to see how this is the pivot that actually adds liquidity and supports us moving to much higher valuations.
Right. Absolute distinction. We still have the Fed that's vigilant and is seeming like perhaps could be emboldened by what markets have done to do a little bit more, perhaps.
Well, certainly, because the Fed has said that they want to see financial conditions tighten. That's how they get control of inflation. You control financial conditions, and that slows the economy down. They've also said that they want to see real yields move higher. And that's what really drove this rally recently. We saw real yields move down significantly from the June high. They fell 70 basis points. That's behind the whole multiple expansion that we've seen. So that's counter to what the Fed wants. The question is, how much is the Fed going to fight this market?
Yes, that is the question. And, in fact, they don't directly target financial conditions, but financial conditions are the tool to do what they want to do. So we'll see how it plays out. The market seems to be enjoying the fact there isn't a Fed meeting in August. We do get the minutes next week, but I do wonder, if you think that upside is going to be difficult from here, the market's then probably giving you an opportunity to either lighten up on things, rotate around, reallocate to areas that maybe haven't participated?
Yeah, that's been a thing that we've been debating. Does it make sense to re-engage on some hedges here, right? So the idea is let's take a little bit of chips off the table. Now, a lot of our investors are very long-term investors, tax sensitive, so we're less likely to be moving in and out in very short-term periods. But the other part of this is we've seen quality lags significantly on this upside. This upcycle has been all about beta and less quality names, lower quality junk things. And so that's where we say, okay, we can buy some of these names that have lagged, and that could be a good opportunity in the near term.
I wonder about the earnings picture at this point. Clearly, people were braced for something a lot worse in terms of profit reporting season. And yes, valuation based on the consensus right now is stretched, relative to history. Some would argue a lot of that is the mega cap growth stocks that are inflating it. But I wonder if we're at a stage where just the reliability or the plausibility of the earnings forecast can support things for a while.
I think that's so important because if we see earnings surprise to the upside, that's what makes valuations a lot less egregious. Right. But if we look at earnings for this year, they're expected to grow 11%. Next year, they're expected to grow another 8%. So a deceleration. Now, if you look under the surface, some key cyclical sectors like consumer discretionary discretionary. 17% growth this year. The market has it marked down for 30% growth next year. So that's not pricing in a dire scenario. And so usually when we have a recession and we have a weak economic period, earnings get cut so much that you can pay a lot for those earnings because you know that they're going to reaccelerate. That's not really the case because estimates are still pretty high.